Good afternoon. My name is Thomas Seneca, founding partner of TM Wealth Management, and thanks for joining us today on our webinar, Are You Ready for Tax Season? And we appreciate your time, and this will take us about 20 to 30 minutes to work through the materials. If you'd like copies of the materials, just email us afterwards. We like to keep these pretty short and concise, so we don't have time for questions. But if you do have any questions after, please feel free to email us. You also get a link to be able to schedule some time if you have specific questions that you'd like to ask, and we can give you some advice on. Quick little disclaimer that what we do here is for educational purposes. This is not designed to be tax or legal advice or even financial advice specific to you. We are happy to meet with you to give you specific financial advice. But the information today is really for educational and information purposes only. Just a little bit of background on me. Started my career on Wall Street, working for Goldman Sachs and Deutsche Bank, doing large investment banking transactions, M&A, IPOs. And while I enjoyed my time on Wall Street, I learned two really important things about myself. One is that investment banking is not conducive to a family, and that is something that's important to me. I have 4 kids. And the second thing that I learned is that I need to be doing something that I feel really has an impact. And while you can argue an M&A transaction or an IPO has an impact, but not the kind of impact that I wanted to have. So now transitioning into wealth management, being able to sit across from families and individuals, helping them make good decisions with their money so that they can have an impact on the people and causes they care about most is really fulfilling for me. And so that's why I started TM Wealth Management. And everything you need to know about us is in our logo. Right? So we are independent, meaning that we don't have a home office that says, hey, these are the products that we need to be promoting, or here's the strategies that are important. We work for our clients. Secondly, we're boutique. Working at large bulge bracket investment banks, I learned the benefits and the downside to size. And for me, in structuring a wealth management practice, I wanted to keep us relatively small. So that we can spend the time with our clients to go deep, understand everything that's going on in their financial lives, and give them the best advice so they can have good financial outcomes. Also, wealth management was important, right? Not just, hey, let's just look at your portfolio, only focus on the investment piece, because we know there's a lot more going on in clients' lives than just their investments. So estate planning, tax planning, investments, financial planning, insurance, risk management, all of these come together to help you make the best decisions for you. And then lastly, the way in which we're structured, we are a registered investment advisor. We function under the fiduciary standard. We felt that was important to align our interests with our clients' interests. Great. So that's the commercial. Just to give you a little background on taxes, as that's our topic today. The first tax amendment was proposed in 1909. Was ratified in 1913 by 3/4 of the then 48 states. It was really originally proposed as a tax on the rich. And in 1913, only 1% of the population paid an income tax at a rate of 1%. Well, we've come a long way since then. Now everybody, for the most part, pays a tax. And if we look historically where tax rates have gone, right, during World War II, we had significantly high, the top marginal tax bracket was 94%, and it's come down since the 1980s. And now we are in a relatively low tax environment where the top tax bracket is at the 37% rate. Now, there's some talk about Congress working to extend the Trump era tax rates. We expect that to get done sometime this year, so maybe we'll have some continued years of lower tax rates. But if nothing gets done, tax rates go up. So the top tax rate in 2026 will be the 39.5% rate. But there is a lot of talk that will get adjusted and dealt with in this session of Congress. And this gives you a sense of where we are in 2024 as you get ready to file your taxes. If you're married filing jointly, again, the top rate is 37%. And you hit that at $731,000 of taxable income. One of the key things that the Trump era tax rates did was increase the brackets for inflation. And so you can see in 2025, that top tax bracket goes up by about $20,000. So yes, we're in a lower tax environment, and less money given inflation is being taxed at that higher rate because of these inflation-adjusted brackets. It's also important to remember some of the changes, right? So we have a higher standard deduction this year that is also indexed for inflation. So married filing jointly, they're getting almost $30,000 of a standard tax deduction. It's important to remember if you itemize, and we'll talk a little bit more about this as we get to the end of the presentation about what you can start to do in 2025 to manage your tax liability. That standard deduction limits, can potentially limit the benefits you get from charitable deductions, and other itemized benefits that you get if the standard deduction is above what your itemized amounts are. Additionally, capital gains rates, there's the 15%, which caps out for married individuals at $583,000 this year, at just under $583,000. Once you get over that cap, now you get taxed at the 20% rate, and then also your net interest income rate starts to kick in as well. So just be aware of some of these things as you start to get your tax documents in place as well. Retirement savings limits in 2024. This is important because we can still do some of these contributions, and I'll talk about that here in just a minute. But for IRAs in 2024, the under 50 limit is $7,000. The over 50 limit is $1,000. Another key change for your 2025 as you start to do your planning for tax year 2025 is now if you are between age 60 and 63, you get an added catch-up limit, right? So now you can put over $30,000 into your qualified plans, your 403Bs, your 401Ks, if you're between 60 and 63. So you want to go back and check your contribution amounts for this year. So are you ready for tax season? There's a couple of things we want to make sure as you get ready to compile all your documents, whether you work with a tax professional or do it yourself. Here's some key things to think about. One, get yourself organized. Try not to do this piecemeal. One of the key recommendations we make is create an electronic folder and also a physical folder. So when stuff shows up throughout the year, you can just put it in those folders and then you're ready to go when you're ready to sit down with your tax professional or in front of your computer to file your taxes. Also consider life changes throughout the year. Think about what happened. What did you get married? Did you get divorced? Some of these other things that we'll talk about. Think about what happened and the tax implications that those might have. And then we want to maximize your deductions for 2024. So IRAs and HSAs, you can still do those and get the tax benefit for your 2024 tax year. And we'll talk about that. And then lastly, we want to highlight, what can we be doing now in this year to minimize our tax liability for the next time we file taxes in April of 2026. So let's get into it, get organized, right? So preparation will significantly reduce your stress. If you're constantly trying to figure out where is stuff, did I get this form, did I not get this form, where is it? That can add to the stress, right? So make sure you've gotten your 1099s, your W-2s, your investment income statements, receipts for any deductible expenses. So really getting organized. And then one key thing I want to highlight, because there's usually a lot of fraud that comes into tax season, whether it's fraudulently filing tax refunds for people that didn't file, or looking at, did you get your refund? So the IRS urges taxpayers to use their identity protection PINs. And this is a PIN that you can apply for. And you can see at the bottom here that the IRS website where you can go and apply for this. And what this does, it prevents someone else from filing your tax return using your Social Security number. So that PIN knows that it's associated only with you. So that's a key thing to think about in terms of getting ready to file your return and getting organized. Secondly, consider these life changes, right? So marriage or divorce, now you're either married filing jointly or individual filing, or if there's someone passed away, right? These are some of the concerns to make sure that you're using the right status for your filing. Also, in a divorce, there are significant documentation and asset division pieces that will avoid any penalties or taxes associated with IRA distributions or divisions. Did you have any kids? And what are the benefits there in terms of the tax elements? And did you adopt? All of these have a tax impact. Did you change careers? Did you look for a job? Those expenses can be tax deductible if you were looking for a job or traveling to explore a new job, and any significant increases or decreases in income, bonuses. All of those things can contribute to your tax liability. So you just want to think through some of those. Did you buy a home? The property and investment changes, right? Did you buy a home? Did you buy an investment property? All of these things can have a significant impact on your tax liability. And then lastly, any health or personal circumstances, right? Any major medical expenses, disability status, relocation for work, any charitable contributions that you may have done. So as you start to think through the year, right? Did I participate in that charitable golf tournament? Did I make a donation? Did I pay for my participation in there to a charity? All of these things can be used as tax deductions. So you just want to think through the year. What did you do, and what may have changed in your life situation? So we can also look at, does it make sense to donate stock instead of cash? And this is something we want to look at for next year. So as we think about 2025, think about donating cash versus donating stock. That's something maybe worth taking a look at. We'll talk a little bit more about that. I'll bring that up here at the end. Retirement savings plan contributions, right? So you can still make these contributions before the April 15th deadline. Again, if you're under 50, that's a $7,000 contribution. If you're over 50, that's an $8,000, and that can reduce your tax liability, right? So if you make a traditional IRA contribution now before you file your tax returns, then it can reduce your taxable income by $7,000 or $8,000. Also, you may want to do a Roth contribution. That may not reduce your tax liability, but being able to get money into a tax-free vehicle, if you can contribute directly, is an important element of your tax planning and also your retirement planning. So looking at those vehicles, because once that year is gone, meaning once you don't contribute into an IRA for 2024, you can't double up the next year or in the future. So once that year's gone, you've lost that opportunity to contribute both, whether it's a traditional IRA or a Roth IRA. And then just one point of reminder, you can only contribute to one or the other in terms of the maximum. So you can't do 7,000 in a traditional and 7,000 in a Roth. But what you could do is you could do 3,000 in a traditional and 4,000 in a Roth if 7,000 is your limit, or 4 and 4 if 8,000 is your limit. So you can contribute to both types of IRAs, but the combined contribution amount can't exceed the 7,000 or 8,000 depending on your age. Another piece that some people forget is your health savings accounts. You can also still contribute to your health savings accounts before you file your tax return. So if you are part of a high deductible plan and you're eligible to make HSA contributions, right, that's an $8,300 contribution for a family. And if you're over 55, that's another $1,000 that you can make on top of that. That can then reduce your tax liability. And then that money grows tax-free if you ultimately use it for medical expenses. And so if you think about what allows me to qualify in terms of making HSA contributions, you've got to be in an HSA eligible health plan. So for 2024, that means an annual deductible for somebody that is single, $1,600. And if for a family, it's $3,200 is the annual deductible. And the out-of-pocket maximum, including the deductible, does not exceed $8,000 or $16,000, depending on your family status. And you also remember that once you start Medicare, you can't contribute to an HSA anymore. But you've also got to make sure that you are part of an HSA eligible health plan, right? These are usually high deductible plans, and you're not claimed as a dependent on somebody else's tax return. So that's a significant benefit that you can still do. So if you combine those two, the call it $8,300 in HSA savings, that's a tax deduction. And then if you do another 8,000 in IRA contributions, right, that's a $16,000 tax deduction. And if you are in the 20% tax bracket, right, that's going to save you, almost $3,200 in taxes. So that's a great way to lower your tax liability, but also still have that money go towards things that are important to you, retirement savings and healthcare savings. Now, some people might be thinking, well, I don't qualify for, I make too much money to be able to contribute directly to a Roth IRA, and I can't take the tax deduction for a traditional IRA. Why would I continue to contribute to an IRA in that year? And the backdoor Roth is a specific reason, is one option, but there's two reasons, right? Just because a traditional IRA, just because you can't contribute directly to a traditional IRA doesn't mean that you shouldn't. What I mean by that is just because you don't get a tax deduction in a traditional IRA doesn't mean you shouldn't, right? Because what you're putting in is after-tax money. So yes, you put $8,000 into a traditional IRA, but that money will not get taxed again. So even if you don't do a backdoor Roth that we'll walk through here in just a minute, if you put $8,000 in a traditional IRA and you do not qualify for the tax deduction, you can still put the $8,000 in. And let's say, years later, it grows to be $16,000. And you pull that money out, you're only going to be taxed on the $8,000 of growth, not on the $8,000 that you already put in, because that's already been taxed. And now you've got that money in a vehicle that you can buy and sell different securities and not be subject to any capital gains tax, short or long term, because this is that traditional IRA wrapper. So that's something to look at. Even though you may not qualify for the deduction, it still might make some sense to put after-tax money into a traditional IRA. One of the other reasons to put money into a traditional IRA is to get money into a Roth. So if you can't put money directly into a Roth because your income is above the limit, which is about $200,000 of taxable income, you can then no longer contribute directly to a Roth IRA. You can get money into a Roth using the backdoor Roth strategy. That's where we contribute after-tax money to a traditional IRA, as in step one here. Then you convert that money to a Roth IRA. And because the money in there has already been taxed, that $8,000 that you transfer now is tax-free because you've already paid the tax on it. You would only have to pay tax if there were gain. So if that $8,000 in the traditional IRA grew to $9,000 and then you transferred it or did a Roth conversion, you'd have to pay tax on that $1,000 of gain. Additionally, in step three, you need to be aware of the pro rata rule and be aware that the IRS looks at IRAs as one account. Even if you have an IRA at a Schwab and an IRA at Fidelity and an IRA at E-Trade, the IRS says, no, that's one IRA. And you can't just say, I'm only going to convert my Schwab IRA. The IRS has a calculation where you've got to go through and figure out how much of my conversion is after-tax versus pre-tax money, and it may make it tax-wise, may make it unreasonable to make that conversion. So you got to be aware of that. But once you do that conversion, if it works out, if it makes sense for you tax-wise, you just fill out Form 8606, and you keep doing this every single year, right? So it's a way for you to get money into a tax-free vehicle if you can't do it directly through a Roth IRA contribution. Now, again, this is something, the conversion part will only impact your 2025 taxes, but getting the money into a traditional IRA is something you do that might impact your 2024 taxes. So something to think about. Additionally, in planning for 2025, be aware of tax loss harvesting, right? So we look at some losses, and given where the markets are over the last couple of days, I'm sure there's some things in your portfolio that might have some losses. It may make sense to sell those, realize the loss, reinvest those proceeds into something similar so you have the same return potential, but now you've captured that loss. Just like we lay out here, right? Joe and Sue bought 100K of the SPY and it lost $30,000. So they sell it. They lock in that $30,000 realized loss. They reinvest into something different but similar. So now they have the large cap value fund, which now increases from 70 to 92. So they've made $22,000 on that investment. Then when they go to file their taxes in the following year, right, that $30,000 of losses, they can use to offset the gains that they had in the large cap value fund, that $22,000. So the $22,000 is offset from the loss. They can also take $3,000, that's the limit every year that you can apply to your future or to your ordinary income. And then since they've only used $25,000 of the $30,000 loss, that $5,000 can be carried over to the next year. One, to use $3,000 to offset ordinary income, but also use $5,000 or any portion of that to offset any capital gains that they have in the following tax year. So something to be aware of and plan for to help limit your tax liability in 2025 as well. We talked about the concern with bunching your charitable deductions. So this is, if you do a lot of charitable giving, we work with a lot of clients that, whether it's donating to their church or their charities or other nonprofit organizations, we want to bunch those together to make sure you're getting the value out of those contributions. And it's becoming more important as the standard deduction keeps rising, right? So for this year, it's going to be, or for next year, it's going to be over 30,000 is the standard deduction. So this just looks at two different options, right? So if still making the same charitable contribution, looking at 2023, they make a $10,000 charitable contribution. They've got other deductions of $13,000, but the standard deduction 2023 is $27,700. So it wouldn't make sense for them to itemize because they get a lower tax benefit by itemizing than they do from using the standard deduction. So essentially in that scenario, your deductions, your charitable contributions provide you no tax benefit. Same thing in 2024. They do another $10,000 deduction or contribution. They've got $13,000 in other deductions. That could be things like the SALT deduction or interest income. But again, the standard deduction is $29,200. So they don't get the benefit. It would be more advantageous for them to take the standard deduction. And so their total 2-year deduction would be $56,900. So when we talk about bunching, we say, hey, if you're going to continue to do some systematic charitable deductions or charitable contributions, let's do that a little more tax efficiently. So option 2 would be to bunch them together. So in 2023, they do a $20,000 charitable contribution. And the other thing to think about is you could do these contributions to a donor advised fund. You don't have to identify the specific charity in the year you want to do some of these bunching charitable contributions. So you can do it to donor advised fund. You can give $20,000 to your charity, to your church, whatever it might be. Same other deductions, $13,000. So their total itemized deduction in that year is $33,000. That's more than the standard deduction of $27,700. So they do the itemized. So they get $33,000 of itemized. The following year, they could give the same $10,000 to the charity out of their donor advised fund that they contributed to in 2023. They won't get any tax deduction for it, but it allows them then to spread it out rather than giving the charity a huge donation in one year. So that year in 2024, they don't take the standard deduction, or they do take the standard deduction. So that gives them a total 2-year deduction of $62,200, right? So over a $5,000 added tax deduction just by doing your charitable contributions in different formats and bunching them together. So something to be aware of to be a little more tax efficient with your overall strategy there. Great. So we covered a lot, and the question is, okay, so now what do I do? Well, just remember, let's recap. Get yourself organized. And if you weren't organized this year, get yourself organized for 2025 tax year, right? Like I said, get a folder set up in the home, in your office to deal with those documents when they show up in the mail. Also set up an online folder, so anything that comes to you electronically, you can just drop it right in there. Review the year. Think about, did I go on any business trips? Can I use those as itemized deductions? Did I start a business? Did I get married? Did we have a kid? Did I get divorced? Did I buy a new home or an investment property or any of those kinds of things? Think through those and talk with your tax professional, or review if you're doing it yourself. Review those to see what the tax implications might be. Look at maximizing your deductions for 2024 by looking at IRA contributions and HSA contributions. And then get ready for 2025, right? By looking at whether it's tax loss harvesting or backdoor Roth strategies or bunching your charitable contributions to make sure you're getting the most tax efficient use of those contributions. And then lastly, we would recommend that you schedule an initial consultation with us. There's no charge, there's no sales. It is very complimentary. Just an opportunity for you to ask some questions to see how these specific principles can apply to your unique financial situation. We've got great reviews from everyone that's been engaged with us. And so would be happy to engage with you to answer any questions you might have on the specifics of how to apply these principles to your unique financial situation. Additionally, we have a number of resources, right? So we put out every year a year-end tax planning guide, some deadlines to be aware of, some key tax facts, whether it's estate planning or tax planning or financial planning. Feel free to reach out to us with a request for any of the resources that we have. And in addition, if you have any questions about what we've talked about today, just let us know and we'll schedule some time to review those. If you'd like copies of the slides or a replay of the webinar, let us know that as well. Our goal is to really provide the education so that you can make the best financial decisions for you. Whether or not you work with us is up to you. If we find that we can add value to your situation, we'd love to have that conversation. But we find that if we can just continue to provide valuable content and education, ultimately we find that people appreciate that and will reach out to us to get specific questions answered, and that's worked out really well for us. At the end of the day, thank you for spending some time with us. We hope this has been helpful for you as you prepare for tax season. We know it can be stressful, but I think the more you can prepare, get yourself organized, think through the year, and then also getting yourself ready for the next year to make sure you're as tax efficient as possible. So with that, thanks for joining us for a webinar. Please keep your eyes open for our other webinars that we do on a monthly basis. Try and keep them tight and concise so that you can get some value and make good financial decisions. From there, have a great rest of your day, and thanks for joining us.